That I am, Scott, I guess. The data is what it is. It's not whether I like it or don't like it. It just is what it is.
Yeah, so what's the problem with it?
So the problem is that we're celebrating, you just said, not as strong as feared. Well, you have to remember that this quarter, expectations came drastically down in the quarter itself. And so in June, we were looking at 10% earnings growth projected for the quarter. We're now at September 30th, we're looking at 2.8% earnings growth projected for the quarter. And we've experienced a blended rate of about 1.7% thus far. This week may make it different, but at the end of the day, that we have managed to minimally beat expectations on a quarter where expectations came down so drastically is not cause for celebration for me.
And you don't think that this week, well, first of all, there are people who think that this rally has legs to go, even if they agree with you. There are those who say, well, I mean, of course he's right. Earnings are going to come home to roost eventually, but not yet. So why not ride with, who you came with rather than get off altogether now?
I see sentiment-driven reasons for people believing that the rally has legs, much like I saw in July, much like I saw at the first week of this month. But I don't see any substantive data-driven reasons. At the end of the day, I try and count catalysts. I can't see a positive catalyst out there. I can see several negatives, including the fact that earnings need to come down for the fourth quarter. We're projecting 4% earnings growth off the back of this quarter, where we're experiencing 1.7%. We're expecting, well, consensus is expecting 8% for next year. Again, we're delivering 1.7 right now. And as the bullish argument likes to presuppose, the Fed's actions have a lag effect. Even if you don't believe that they'll do anything else after this, you still have to believe that the actions they've taken thus far will have an impact. So
no
how
doubt.
we get from 1.7% this quarter to 8% next year is well beyond me. We got QT, we've got a war still going on, we've got slowdown going on in the rest of the world, we've got a strong dollar. I need both hands to count the negative catalysts.
So what if I told you this? Just simple question. I mean, if I told you everything you say makes perfect sense, a lot of people agree with you, but stocks can go up 10% minimum between now and the end of the year. You say, I don't care, I'm going to sit it out because I know what's coming? Or how do you answer that? Because even somebody like Mike Wilson from Morgan Stanley, who's been as right as you from the beginning of the year, says rates are poised to come in. Such a move could provide the necessary fuel for the next leg of the tactical rally in stocks until we get full capitulation on earnings, something we think may take a few more months.
And that's true. And I guess it depends on what your duration is. And so, I care very little for week-on-week moves at the end of the day because I don't react in those time frames. So it very may well be the case, just like we've seen with every head fake rally, that sentiment may in fact drive that performance. But at the end of the day, you can't point to a data-driven substantial catalyst as to why we're moving there. We've had earnings come in slightly below expectations, very much lowered expectations vis-a-vis history. We still have all these negative catalysts to go. I think we're actually going to get a very somber earnings week this week. I disagree with Kevin on one thing. While digital advertising is still poised to grow, and it's one of the few segments of the economy that are still poised to grow, while the cloud is still poised to grow, and I've long thought those safe havens, the question is not relative to everything else. The question will be relative to itself. How will investors judge that growth? And so if the cloud decelerates more than is expected, which I think will happen, investors, I think, will look upon that poorly. If digital advertising, we've already got a preview from Snap, although they're exposed to very unique competitive forces. I think we'll see weakness across the board, particularly when you think about the dynamics of supply and demand. In the digital advertising market, we are bringing on boatloads of supply from Netflix, from Amazon, even from Uber and Lyft. And at the end of the day, advertisers are pulling in their budgets right now.
Netflix is selling out their inventory.